Aloha, good morning. This is Caron Davis, broker owner of Caron Realty International. And today we have Duncan back from his company. He's loan originator and president of Infinite Financial. And welcome, Duncan. We look forward to hearing from you again today about the mortgage rates. Of course, you know, we've heard lots of rumors and we'll go into some detail. But before I go there, of course, big weekend. Happy May Day, everybody. I know May Day is Lay Day in Hawaii, and it was established in 1929. It's a statewide celebration where customary, it's, people wear beautiful necklaces of flowers, leaves, feathers, or shells. And plumeria comes in all different colors, and we'll enjoy that in some of the photos I show later here this morning. And just a little note on some events going on for May Day Sunday, is at Kapulani Park at the bandstand there. They have a lei contest and lots of artists giving their exhibitions. And I'm sure today there's a lot of schools celebrating and parents enjoying their young kikis, doing hula dancing. It's such a fun day at the schools also. Well, with that, Duncan, welcome back again. And every time I meet a client, whether it's a seller or buyer, what's going to happen with the market with the interest rates going up? So I suppose one of the questions is, how do the interest rates, who determines the interest rates to be going up at this stage?
Well, on mortgages, mortgage-backed securities is what determines what interest rates are for mortgages. So there's a big misperception on a lot of buyers or borrowers that the mortgage rates are controlled by the Fed. The Federal Reserve Board does not control mortgage rates. They control the federal funds rate, the Fed funds rate. So when you hear that the Fed is hiking rates, they're not hiking mortgage rates. They're hiking the short-term overnight lending rates to banks. And that affects the short-term rates. And for example, the Fed funds rate is only at 0.5% right now. So they have a long way to go to increase it. And they're expected to hike those short-term rates up to about 2% by the end of the year. So people hear that the Fed's hiking rates and they think that means the mortgage rates are still going to go much higher. But I believe, mortgage rates have already moved up 2.5% on average in the last 6 months or so. So you've already seen a huge move in the mortgage market on expectations of inflation. So the mortgage-backed securities are controlled by traders. The Fed does have some effect on it because they have purchased some mortgage-backed securities and long-term treasuries during the last few years, and they're going to be selling some of those. So it does have some impact, but they don't directly control the rate like they do on the Fed funds rate. So that has forced mortgage rates up on the biggest increase ever in a quarter. The 10-year treasury had the biggest recorded up move last quarter, and the long-term rates have had this giant move already, and I don't think that you're going to see similar giant move going forward, even though the Fed hasn't really started hiking rates that much. Much of the expectations of the Fed hiking rates and inflation being really high has already been priced into the mortgage market. So I think most of the move has already happened, at least in the next year or so. So we've already seen mortgages move up to an average on a survey is about 5.4%. So it's a big move from under 3% last year at the lows. So there's been already a big move up in the mortgage market. The Fed's going to hike up to about 2%, and then that it's not necessarily that if they hike another 1.5%, say on the Fed funds rate, doesn't mean that the mortgage rates are going to move up another 1.5%, since they've already moved up over 2%. So there's different markets, but they kind of are related, but the short-term rates and what the Fed controls directly is different from mortgage, long-term 30-year fixed mortgage rates.
Do you think they'll, what's the current 30-year rate right now, Duncan?
On average, it's 5.4%, right around there. They're based on a national survey of mortgages, and the rates will depend on someone's credit score, the occupancy, the type of loan, a lot of different factors, but on average, on a national survey, 5.4%.
And then the question I have on that is you know, a lot of people, I remember, you know, when we went through changes in rates probably 15 years ago, but then there was a lot more programs for people to choose from. You know,
Right.
people got quite creative, the lenders, and maybe you can tell some of the programs that you see coming up that people are taking advantage of.
Yeah, so normally, and when rates were super low, most people were doing a normal 30-year fixed mortgage, and there always are a variety of programs for people depending on their background. For veterans, there's the VA loans, and for people with lower credit, they'll go with FHA loans, or rural areas, USDA loans, and then it's conventional and jumbo. We're seeing more people considering ARMs, adjustable rate mortgages. And there's one particular product we're getting a lot of demand for, because we're one of the only lenders that offers it. It's called an all-in-one loan, whereas you basically get a 30-year credit line that allows you to pay interest only for the entire 30 years and gives you a lot of flexibility. And people like to use that for things like sweep strategies or velocity banking, where they put all their income into that one account. You combine a mortgage credit line and a checking account, a full feature checking account, and then they have all their money in that one account. They're able to pay down their mortgage much faster that way. And so we've gotten a lot of demand for that recently, because it is an adjustable rate product. So it's much more competitive versus a 30-year fix, because you're not seeing 30-year fixed mortgages in the 2s and 3s anymore.
So this is a new product I haven't heard. So basically they're paying interest only, but they have to put their income in this one account.
They don't have to, but they can do that and pay off their mortgage much faster. They've had this program since 2005, and the average for people paying off their mortgage has been 8 to 12 years. So it allows people to pay the mortgage off a lot faster, because the interest is charged simple interest on a daily basis instead of amortized over 30 years. So it allows people who manage their money that way to efficiently and quickly pay down their mortgage. And another thing they can do is it's a credit line. They can use that credit line if they want to buy another property. You can get one of these credit lines up to $3 million, above $2 million on an exception basis. And with $2 million, $3 million credit line, and you pay that down, and you could use that to buy other properties, for investment properties. So it's a good source for people to buy investment properties. And we also are seeing people use life insurance products, because you can build up cash value using life insurance, and using that, you can purchase properties by borrowing against your cash value in life insurance. That's more of a long-term thing. And we also help people with that's called, you can use infinite banking and build up your own banking system. A combination of the velocity banking, using an all-in-one loan on your mortgage to get a credit line that way, and build it, basically having your own credit line against your own banking system by building up cash value and life insurance. It gives people a lot more flexibility. That's something that we offer that other lenders don't. And so we're seeing much more of demand for those types of products instead of the normal 30-year fixed conventional loan.
Well, you know, I think it has a lot to do with financial planning too, which is fantastic. I was just saying the other day, you know, even with the lower rates, you know, and, you know, with the luxury market, you know, I had a client the other day, I heard of somebody's client, I should say, it was a $2 million house, and his mortgage still was $8,000 a month, right? Yeah. And yes, it's a low rate he's involved in, but the reality is, you know, that's a lot per month. And I think we forget that majority of that payment is interest. It's not the equity. So when you're looking at that every month, and like you said, you can pull out of this account to pay the loan down. I think, you know, you're mindful that you're paying all this interest every month, and you want to get rid of that payment. And I like that program. A lot of people would use that. I see that.
Yeah, and one of the big advantages is you don't have to make that principal and interest payment. You just pay the interest on the daily balance. Each day, they charge the interest on a daily basis, and it comes out against the credit line the next month. You don't even have to make any payment; it just comes out against the credit line the next month on the 21st of the month. So you can go for a long time without having any income come in, because once you pay down your mortgage, you have a lot of credit line available, and you're only making interest payments each month. Then you can survive a lot longer if things turn bad. Say that you get a recession in a few years, and you have a business, and your business isn't making any money. You can, and that has happened in the last couple of recessions. People with this loan they haven't had any defaults. So they've never had any defaults or delinquencies on this loan. So it's a lot safer, a lot more flexible than a 30-year fixed. You're not required to make that fully amortized payment over 30 years. And so when you have hit rough times, then you can borrow against that, or you have the payments just come out of the credit line. And they have had people that have not had income for years, and they're able to get they don't lose their house. They're not foreclosed on their house because they have that credit line. They have the equity, so they don't have to they don't have to sell the house on a short sale, or they're not forced out of the house.
That's wonderful. Yeah, I really think that, when we had the mortgage crisis, a few years ago now, people have got a lot, and it was hard for people to get loans because as a mortgage broker, it was hard for you even to fund loans. But I believe we went through that. We got back to a little bit more of a normal market with the great rates. But now we're going back to creativity, even better creativity. Or like you said, this program's been around since 2005, but no one's used it.
There are people that have been using it, but it's more popular when rates are going higher, where it's more competitive. We also are seeing a lot more recently the loans that are based on the income of the property. DSCR loans, debt service coverage ratio loans, are loans where we don't need any income documentation from the borrower, and the qualifying is based on the property and the rental income on the property. So we're seeing that be a lot more popular. You don't have to go through all the hassles of verifying your income, and especially with people with complicated income situations, they can buy properties using the income from the property that they're buying as an investment rather than using their own income. We also have a couple lenders where we can do a no ratio loan where they don't have to use any income for qualifying on either an investment property. We can also do it for a primary residence or a second home. So there's that becoming real handy when you have people that don't have income to qualify, but they have to have a significant down payment. But it's a great alternative for people that have unusual income situations. The rate's going to be a little higher than it is going to be on a normal loan. But again, those with rates going up, then paying a little bit more, it's not paying double the rate, it's paying just a little bit more than the rate now that the normal mortgage rates have gone up. So there's a lot more products that are more palatable to people because the rates on the conventional loans have gone up.
Yes, we're going to have to finish up here, and I believe we want to talk about condos, but I think we'll leave that to another time because that in itself is another topic, and hopefully we'll have you back in the next few weeks to talk about the condo market, and of course maintenance fees are really rising right now. But if anyone listening to our show this morning, please email Duncan. Duncan, what's your email if you have questions on loan programs or want to learn more about what Duncan's talked about this morning?
Yeah, it's Duncan, Duncan at infinitefinancialllc.com.
Great. And then on that note, to celebrate on May Day, we'll go to Marianne's photos here just before we finish. And of course, all the beautiful plumerias. And as you can see, this was all with a lei emphasis, being May Day, and absolutely stunning. Beautiful colors. And of course, people got their needles out making those leis today. But anyway, happy May Day, everybody. Thank you for tuning in today. And thank you so much, Duncan. It's always so interesting listening to you. I really thank you. Aloha, much aloha.
Take care.